This is the first in a series of 5 webinars that we've scheduled to focus on different aspects of the farm economy. These Learn at Lunch sessions that we're calling them are part of a partnership commitment with USDA's Farm Service Agency to offer borrower education. As inferred by the title, the forecast is a mix of weather in the near future, with some parts likely more pleasant than others. It's clear that cash flow problems are increasing and that equity positions are eroding some. Perhaps the best face that we can put on the near-term outlook is that the rate of deterioration on a number of fronts has slowed. We think it's important for all of us, producers, ag lenders, educators, and others with interest in agriculture, be attuned to changing circumstances so that we can respond appropriately. And for producers, the appropriate response depends on the individual farm financial position and circumstances. Rodney and I are going to take turns sharing our thoughts. I'll start out by highlighting some things that we put in the partly cloudy column, and I'll show some charts providing more perspective with many of these. Debt levels are on the increase. Loan performance is deteriorating as evidenced by data from sources such as the Kansas City Fed's Ag Credit Survey of Agricultural Lenders. Interest rates are still low but beginning to increase. In fact, there's an announcement this morning that Chairman Yellen is suggesting that an increase might come in the next month. Real estate values have decreased in the past year, but not dramatically, at least in Oklahoma. A strong dollar is good for us as consumers and buying imports, but not good for us as food and ag commodity exporters. The wheat and cattle prices aren't expected to increase significantly this year, but you'll have an entire webinar for both crop and livestock market outlook to explore these more. Trade uncertainty. Many of the commodities that we produce in Oklahoma benefit greatly from sales abroad. As I've told some of my fellow Rotarians at lunch meetings, they can't eat all the wheat and beef that we produce in Oklahoma, so we need trade. The new administration's emphasis on renegotiating trade deals brings with it some uncertainty for ag markets. I might also point out that with respect to the general economy, Dr. Sanders and Scheidler did a webinar last week, so if you're interested in more macroeconomic, general economic outlook, I'd encourage you to look at that, and we'll have the web link to that at the end where this session will also be archived. If you have questions as we go along, don't hesitate to raise your hand. We'll try to be on the lookout for that, and we'll hope to have plenty of time at the end for additional discussion. This slide comes from a USDA Ag Outlook Forum last week. Debt is shown in the blue at the bottom, and it's at an all-time high, but as you can see, it's dwarfed by the equity in the ag sector shown in the green. Real estate debt is projected to continue to increase, an estimated 7.3%, as land values are still relatively high and there's less cash available for down payments. Non-real estate debt is increasing a bit less, as input costs have declined in recent years and aren't expected to increase dramatically. Cattle prices are low, so livestock purchases are less expensive. Used machinery prices are relatively low, so that contributes to the non-real estate debt increasing at a bit slower pace. Overall, a 2.1% downturn in equity is projected. That's a result of both increasing debt and softening land and machinery prices. I expect these same patterns to play out in Oklahoma in the coming year: increasing debt, decreasing asset values, both of which decrease equity. Ag sector solvency ratios derived from balance sheet values, such as the debt-to-asset ratio, have been increasing. They're now above their 10-year average, but still below historical averages and well below the 1980s farm crisis levels. The sector debt-to-asset ratio is forecast to increase to about 13.9%. In 1986, it was about 22%. Looking at sector-level statistics masks a lot of variability in individual situations within a geographic region and within different commodity sectors. For the U.S. and for Oklahoma, likely, about 40% of the farms have no debt, and that was true even during the farm crisis. Typically, the farms with no debt are older operators who've had an opportunity to pay down debt. This, of course, provides cushion during downturns. At the other extreme, we have a smaller number of farm operators with high levels of debt, and that's what this chart shows. It shows the growth in the percentage of farms with leverage ratios over 40%. The solid line is the percent of farms with debt-to-asset ratios between 40 and 70%. So you can see for crop farms, it's at 6.3% compared to 5.4% for animal and livestock product farms. The dashed line shows the percent of farms with even higher debt-to-asset ratios, those with more than 70%. 5% of crop farms and 4.9% of livestock farms fall in that category. So in total for the U.S., 11.3% of crop farms have debt-to-asset ratios greater than 40%, and 10.3% of livestock farms have debt-to-asset ratios over 40%. So 4 cents, 40 cents on the dollar is owed to a different party. While we don't have state-level statistics, I expect that Oklahoma statistics would be similar, with roughly 1 in 10 operators having debt-to-asset ratios over 40%. Getting a bit closer to home, this is data from the Kansas City Federal Reserve Bank's Ag Credit Survey. The 10th Federal Reserve District includes Oklahoma, Kansas, Nebraska, western Missouri, Wyoming, Colorado, and northern New Mexico. So the green bars show changes in expected farm loan demand. So you can see it's in recent years it's been at higher levels. As farm cash flow and income problems increase, loan demand tends to increase. At the same time, loan repayment often slows, and so the dashed or the green line on the chart shows loan repayment rates, and you can see they've dropped off dramatically since 2014. The good news is that while the rate remains high, the expected rate of change has flattened, and that's similar with regards to the rate of expected loan renewals, in that increases in loan renewals or extensions occur when producers are not able to make timely payments because of decreases in commodity prices, crop failures, and so on. While the level of loan renewals is high compared to 10 years ago, again, the rate of increase seems to have peaked. Interest rates mostly bottomed out in 2014. Both variable and fixed interest rates have been increasing since then for all types of loans. Risk is priced into the loans, as you see that operating notes have the highest rates, followed by machinery and real estate loans. And fixed interest rates are higher for all categories in anticipation of increasing rates in the future. Part of the increase in ag lending rates is due to increasing overall rates. The Fed has raised rates twice in the last couple of months. And part of the increase is lenders building a bit more of a risk premium into agricultural rates in general to account for a bit more perceived repayment risk. Real estate values typically account for about 3/4 of the farm balance sheet assets. When land values fall, the farm's financial position is measured by the value of assets or equity falls. The chart at the top left is from our land value website that shows Oklahoma land values over time from data that's contributed from farm credit institutions in Oklahoma. And it shows the tremendous appreciation that land values have experienced in the last 15 years. However, things slowed in 2016. While Oklahoma land values have decreased a bit, the declines are small relative to those experienced in the Corn Belt and even in our neighboring state of Kansas, as shown by the chart at the bottom right from the Kansas City Federal Reserve Bank's survey. Expectations of increases in income derived from land provide the foundation for future increases in land values. When incomes are forecast to decline as they are this year, land values can be expected to follow. So expect land values to be soft in the short run. With that, I'll turn it over to Rodney to discuss some of the factors that we put in the partly sunny column.
Thank you, Damona. If someone would hold up their hand to make sure that that I'm coming through, that would be great. And for that, here I want to elaborate on some factors that might be considered a bright spot in the farm financial outlook picture, or in that partly sunny portion of our forecast. A few items that we placed in that category include leveling off or even decreases in operating expenses, some modest crop and livestock price increases, a general level of producer optimism out there as reflected by some recent surveys. PLC farm program payments are going to be large for some producers in 2017. I'll elaborate on that here in just a few minutes. New loan volume is actually declining a little bit. We'll speculate on how or why that may be happening here in just a few minutes. We've got a continuation of historically low interest rates, even though seen some slight increases here lately. Off-farm income and its contribution to family living standards for farm families is certainly a positive note. And there are a lot of good opportunities in the used equipment market for those needing to replace or update machinery who are in a position to do so. While this list that we've come up with may not be all-inclusive, it represents the most common positives that we were able to come up with. So let's explore these factors a little bit more with the following charts and discussion. In general, production expenses have been declining, at least modestly, since about 2014 and are expected to remain steady, actually decline in real terms again here in 2017. These declines are driven by lower negotiated cash rents, lower fertilizer expenses, and to some extent lower equipment costs. Admittedly, some of these expense reductions are more pronounced and have a larger impact on Corn Belt producers than on a typical Oklahoma producer, but at least some production expenses are not projected to, at least production expenses in general, are not expected to increase, even here in Oklahoma. Furthermore, some commodity prices are expected to rebound somewhat in 2017. Specific examples include dairy and cotton prices, which are expected to be stronger. Again, strength in the price of these particular commodities may not help Oklahoma producers as much as producers in some other areas, although certainly cotton price increases would be a benefit to some regions of Oklahoma. According to some recent surveys, there is, at least for the moment, a significant bump in the level of optimism in some regions of farm country. For example, a recent Corn Belt survey found that overall attitudes and optimism were at the highest levels in at least a couple of years. Additional questions on that particular survey indicated that factors such as expenses coming down somewhat and commodity prices at least stabilizing, if not increasing a little bit, fueled at least a portion of that optimism. But a lot of that optimism, according to that particular survey, seemed to be driven by hopes of some regulatory or cost relief. That's kind of interesting because the magnitude of the direct benefit of those types of policy actions seem to be fairly unpredictable at best. But with that said, there is a lot of optimism out there in farm country in general, at least in some regions of the country. Overall, commodity farm program payments are expected to be down just a little bit in 2017. However, pertaining to Oklahoma and Southern Plains agriculture, that price loss coverage component, or PLC payments for wheat in 2017, which would be for the 2016 crop, will be up significantly. As a matter of fact, they've been non-existent up to the 2016 crop. Surprisingly, because of good yields, that's the reason I'm surprised at this finding, many counties will also trigger an ARC payment in 2017 for the 2016 crop. Of course, individual producers are either in one program or the other for individual commodities. The jury is still out regarding which of those choices, PLC or ARC, will turn out to be the most beneficial in hindsight when we look back here in a few years, and it will likely depend on what county you're in. In many counties, the 3 years of ARC payments will still net out to be more than the one large PLC payment for the 2016 year, but there's still 2 more program years to go. Um, the overall story here is that at least in Oklahoma, there is likely to be some farm program payments in 2017 for the 2016 year, and some of those will be fairly significant. Though total debt levels are increasing somewhat, as discussed earlier, new loan volume is actually down according to some recent lender surveys. It's difficult to tell exactly what's driving this seemingly contradictory finding, but part of it's likely driven by lower feeder cattle and calf prices, resulting in less money needed to fund those types of operations. On another positive note, while interest rates are creeping up, they're still at levels that are very low from an historical perspective, and are certainly much lower than rates seen in the late 1970s and on into the farm crisis of the 1980s. Another positive factor that we can point to is the fact that the vast majority of farm households get the lion's share of their family income from off-farm sources, and that's certainly true in Oklahoma as well. That off-farm income is expected to be up in 2017. This fact is certainly cushioning the impacts of declining farm incomes for a lot of farm families. Here in Oklahoma, we don't have exactly comparable statistics regarding the overall contribution of off-farm income to farm household budgets. However, as you can see from this chart, overall real personal incomes have started to rebound as the Oklahoma unemployment rate seems to have turned the corner and be headed back down slightly. Again, this is good news for those farm families that rely on off-farm incomes for at least a portion of their total farm family budgets. Another source of non-farm income includes royalties and leases from energy production activities. While this does not impact all Oklahoma producers, according to this chart, it could impact nearly 1/4 of the farm operations in the state. Since this chart is a little dated, the illustrated roughly $60,000 per farm that actually receives energy-related income payment may be higher than it is today. The illustrated payment there may be higher than it is in the current energy price environment. However, we do know for certain that these payments can be a significant source of income for many Oklahoma farm and ranch operations. By the way, it's perfectly fine to be just a little bit jealous of the magnitude of the average annual energy-related payments to the farmers who receive those payments in states like Pennsylvania and North Dakota. Those payments seem relatively high compared to the average payment even here in Oklahoma. Finally, one other positive aspect for some of the overall soft farm economy is the fact that there are some great deals available on good low-hour used machinery. There was, of course, a large quantity of new equipment sold a few years ago during the era of record net farm incomes, and a lot of that machinery that is not very old, still relatively low hours, has found its way onto dealer lots and other used equipment markets. Prices are soft on many items, so if you're in a position to be able to purchase equipment, there's some really good deals available, especially on those big ticket items like combines or very large tractors. I'm sure there's other bright spots that we failed to mention here, but those are the primary ones that came to our minds as we were preparing for this session. Let's turn our attention to the more concerning factors that we placed in the stormy portion of our forecast. Cash flows remain extremely tight for most agricultural enterprises in 2017, as well as the overall profit measures remain very slim. World crop inventories are keeping a lid on crop prices, and plentiful livestock product supplies are keeping cattle and other livestock prices lower than they were just a few short years ago. Of course, every time we prepare a talk or schedule a webinar to mention drought concerns, it rains. With that said, Damona and I are, of course, available to come out and speak in your particular part of the state for a fee anytime you want us to come out there and solve the drought problem. Seriously, regardless of the last 24 hours or so, there are still lingering drought concerns in much of Oklahoma. Let's talk about these issues in just a little bit more detail. Overall, U.S. net farm income is expected to drop for the fourth year in a row in 2017 to a nominal number of $62.3 billion. That's compared to $123.7 billion as recently as 2013 and $80.9 billion as recently as 2015. Profit margins are very tight, and surveys indicate that producers on average have been selling down inventories, i.e. not carrying over as much grain from one year to the next, for example, and are not prepaying as many expenses from one year to the next. It always takes a little while for the cash accounting measures used on most farms and ranches to catch up with the realities that are revealed by the true accrual accounting measures. The data depicted in this particular chart are a year or so old now, but clearly show that as earnings fall and debt levels increase, that ratio of debt to earnings can increase quite rapidly. This measure was considered one of the leading indicators of the degree of financial stress leading into the 1980s. As mentioned earlier, the budgets look very tight for most 2017 crop and livestock enterprises. Here we're only showing income compared to operating costs. In many situations, there would be additional cash outflows for this particular enterprise. For example, for those producers that have a lot of additional fixed cash outlays such as land or machinery payments, the cash flow situation would look much worse than even that depicted in this example budget. Also, if one were to calculate the true profitability measures that include all the opportunity costs, the bottom line would look much worse. It does happen to be the case that the budget projections for one of our primary commodities in Oklahoma, that being wheat, look particularly tough relative to budgets for other crops that are more prominent in other regions. Not that they look that great, they just don't look quite as bad as this budget for wheat might look. Because wheat prices have fallen so much more dramatically over the past several months than the price of some of those other crop commodities. For all crops, we simply have had large world production and currently have large projected carryover ending stocks. In the United States, this is of course compounded by the fact that the value of our dollar remains strong, which makes it more challenging for us to be competitive in the export markets right now. With regards to cattle, herd rebuilding has taken place at a much faster pace than most expected. This, combined with rapidly expanding production in other meats, and again the strong dollar, is impacting prices. The bottom line, significant cash flow and liquidity challenges for many producers, and in many cases even some significant profitability challenges. Of course, one more issue that's certainly on the minds of many Oklahoma producers is the lingering drought concerns. We are very thankful, of course, for the rains over the last day or so in those areas that received some, but many areas of the state are still significantly behind on rainfall, as evidenced by, say, the 120-day or 180-day or even 360-day comparison with historical average information that's available on the Mesonet. Is there a possibility that the drought conditions will continue or even worsen as we get into the growing season? Many producers have already been impacted here early in 2017. Some crop production potential in some regions has already been lost. Forage losses for stocker operators have been incurred, and other concerns have already been expressed by many producers. If the drought continues, it will certainly start to impact many more producers. Damona is going to talk about perhaps some ideas for helping to manage through some of these difficult times.
Thanks, Rodney. And again, if you have questions, you can type them into the chat box if you don't have a microphone. And again, we'll have time for discussion at the end, but don't hesitate to start typing your questions as you have them as we go along. The key to not just surviving but thriving in the long run is management. And so a few ideas for honing your skills in that area. So anticipating and understanding problems requires some introspection and maybe a bit of detective work when it comes to finances. So are cash flow problems temporary until a particular loan is paid off, or maybe market prices come up just a bit? Or has a strategic error been made in expanding too quickly, or maybe in retrospect at a time when prices were too high? So identifying the factors and whether they're internal or external gives you insights into the amount of control you have in fixing the problem. You can impact your cost of production maybe more than you can market prices. Once the problem or problems have been diagnosed, then you're ready to develop tactics for meeting the challenges. Evaluating your options for change should also take a multi-pronged approach in the long view. So in the short run, certainly managing cash flow is essential. You can do that by controlling family living expenses, delaying purchases, negotiating rents, and so on. It may mean looking for ways to supplement income. The ability to respond will be farm specific. In the longer run, knowing your break-even prices and yields is a starting point in focusing on profitability. You have to be able to not only cover cash operating expenses, as were shown in the budget, but also build reserves to replace machinery and equipment, vehicles, and so on. Managing assets means thinking about how you control the things that allow you to farm. Your breeding livestock, machinery and equipment, land. And I purposely said control because you don't have to own everything. Maybe cash flow works better if you rent rather than own. So think about whether assets are fully used, or could machinery, for instance, be better utilized if it was leased out some to others or used for custom work? Could land generate additional income by renting it out for hunting? Can replacement purchases be delayed? If assets are sold, in what order? That may depend on the amount of debt associated with the asset, and certainly you ought to think about selling the least productive assets, remembering that machinery and equipment values, for instance, may have softened as others have already implemented some of these strategies. Managing liabilities, you can do things like shop for credit, look for opportunities to refinance at lower rates, maybe negotiate interest-only payments for a year, again if the problem is short-term. Think about paying off high-cost debt. Managing risk is important in this environment as well. Locking in low interest rates while you have a chance may be important, and certainly looking at crop and livestock insurance choices to ensure that you have a safety net. There isn't a magic bullet, unfortunately, for solving problems, but by identifying the problem, you can zero in on the right strategy to fixing the problem. We don't want to only treat symptoms like cash flow, so you got to study the problem in a bit more depth. But once you've identified the appropriate strategy, it's important to take action after you've got that well thought out plan. And certainly if a lender is helping finance the business, you want to involve them in the discussion early on, as they're in a better position to assist before problems are severe. In good times, family living expenses tend to increase, as do capital purchases of machinery and equipment, vehicles, and land. This chart shows family living expense growth for farms that participate in the Kansas Farm Management Associations. And so you can see how that's increased in recent years. When less good times follow good times, family living withdrawals tend to decrease more slowly. Survey evidence and analysis of farm records does suggest that belt tightening has occurred. Capital purchases are down, as is family living. But again, the fact that averages show adjustments doesn't mean that every individual has done it, so don't overlook possible changes needed in this area. And while both lenders and producers clearly have a vested interest in managing cash flow in the short run, it's in the long run best interest of both if you also pay some attention to profitability. Analyzing cost of production by enterprise gives useful insights into underlying problems. Comparing individual farm data to industry benchmarks like these from the Kansas Farm Management Association data highlights strengths and weaknesses within the operation. In this chart, producers in the low profitability group at right clearly could benefit from better practices related to meeting the cow's nutrition needs. If you look closely at the charts, the blue area shows feed cost and shows that for the low profitability group compared to the high profitability group, there's about a $100 difference. If you look at the pasture cost in the red area, the low profitability group spends about $311 compared to $154. So for the high profitability group, so twice as much. You add those two together, and the low profitability group is spending almost as much on feed and pasture as the high profitability group is spending on the cow overall. So clearly they could learn, the producers in the low profitability group could benefit from learning from those in the high profitability group. Research time and time again, whether it's crop or livestock, whether it's hammers home the differences between the most and least profitable producers is not necessarily the market price received, the weight of the calves at weaning, the size of the operation, the technology they use, but it's how well they manage cost. So marketing is important, profitability is important, production is important, but controlling cost is absolutely critical. And so that's a place that I think everyone can hone in on, starting with their records. We want to remind you there's a variety of extension programs that can help producers think about ways to better manage during challenging times. You can learn more about these programs through your local extension office. IFMAPS provides one-on-one individual assistance in developing farm financial plans and financial statements. It's a fee-based program. Our budget software is available on the website listed here. There are both in-depth templates that can be purchased as well as flatter, simple Excel spreadsheets that you can download for free. And those can be great tools for kind of analyzing what-ifs as prices and circumstances change. Annie's project is targeted to women in agriculture and is designed to focus on farm and family financial management. It's a series of 6 workshops offered locally to improve networking and to help participants hone their management skills. There are currently about a half dozen Master Cattleman classes going on around the state. The Master Cattleman program is a more intensive program focused on not only production, but also economics, finance, marketing, herd health, nutrition. You get the broad spectrum of ideas for how to improve cattle management through the Master Cattleman program. And again, it's a series of workshops based on the Oklahoma Beef Manual. Our new initiative is online borrower training, but the same resources that we're developing that would allow producers to earn credit for FSA borrower training are going to be available for free on our eFarm Management website. It's a work in progress, so materials are continually being added to that, but you can find more information about those 2 resources on the website. Publications are accessible 24/7 on the OSU fact sheet website, and so there are many that are geared towards helping people better analyze their financial situation, identify what level of stress they may be currently at, but also looking at alternatives for change. And so if you're interested in learning more about that, certainly point you to those fact sheets as resources. Hopefully some of you learned about this from this webinar from posts on our Facebook page, but we'd encourage you to find and like both our farm management Facebook page as well as our Oklahoma Women in Ag and Small Business Facebook page. And as you'll get daily or weekly posts about information that may be of value to you. Would also point you to our Ag Econ Extension website. That's where you'll find things like this webinar and other webinars posted. Beefextension.com has a variety of not only spreadsheet tools but also fact sheets as well. So with that, we'll turn it over for any questions that you might have. So here's the slide kind of capturing our discussion points overall. We invite you to raise your hand. We can give you a mic if you have one, or type something in the chat box. You know, we've covered a lot of ground fairly quickly. Surely there's some questions or thoughts, or maybe perhaps agreements or disagreements with things that we've said. Rodney, any final thoughts? We do have a 2-question survey that we'd like for you to fill out. Again, very simple. Looks like some people are typing. Good. Brent has posted a link to the survey that we'd like to have you complete. Again, just a bit of feedback about today's session. We hope that you'll join us for later sessions as well, and we'll have the list of those upcoming once we have a chance to respond to any questions that you may have.
I noticed Brent just posted his email address if you need in-service credit or need to contact him for any other reason. One other reason you might need to contact him is if you yourself or if you know people who are interested in the FSA borrower training component of this joint effort between Oklahoma State University and the Farm Service Agency. Brent is the person that you need to contact to get lined up for that as well. So use that same email address that he posted there.
And Kendall asked whether these slides would be available. Yes, they'll be archived at the same site that the webinar is, so we'll make those available there. Well, thank you very much for joining us. We look forward to interacting with you in future webinars. Please don't hesitate to call or email if you have questions later. But again, we encourage you to fill out our little survey link, provide feedback about how you might use this in your work. Thank you again, and upcoming webinars. Again, the next one will be February 28th, Crop Market Outlook. That will feature Kim Anderson. Our Livestock Market Outlook will feature Daryl Peel. Shannon Farrell will lead the discussion on succession planning, and I'll be updating you on leasing and rental rates in April. Have a great day.